Hello everyone, today we'll be exploring FedEx's debt financing. Over the last 4 years, their debt to assets ratio has remained lower than the industry average, indicating a conservative approach to debt management. Their debt to equity ratio has also been well controlled, ensuring the company remains financially healthy and flexible. Overall, FedEx's capital structure suggests strong financial stability and low financial risk compared to its peers. When we look at FedEx's leverage ratios from 2021 to 2024, we can see that their debt to assets ratio has remained consistently below the industry average. This reflects stable financial management. Similarly, their debt to equity ratio has shown a solid balance, allowing them to leverage equity effectively without taking on excessive debt. Compared to industry peers, FedEx's lower leverage gives them a competitive edge in terms of financial stability. Next, let's take a look at the types of debt reported on FedEx's most recent balance sheet. The company reports both short-term debt, which includes items like accounts payable and accrued expenses, and long-term debt such as bonds, loans, and lease obligations. FedEx uses long-term debt strategically to finance large capital projects, which helps maintain their liquidity for day-to-day operations. Comparing FedEx's short-term and long-term debt, over the past 4 years, their short-term debt has remained stable, which reflects a focus on maintaining operational liquidity. Meanwhile, long-term debt has seen minor fluctuations as the company adjusts its capital expenditures for infrastructure and technology investments. Overall, FedEx holds the majority of its debt in long-term obligation, which signals a focus on long-term growth and stability. Examining debt trends over the past 4 years, we can see that FedEx has maintained a stable level of short-term debt, which indicates conservative liquidity management. The company's long-term debt has seen modest increases as they invest in key areas like infrastructure and technology. For investors, this suggests a well-thought-out balance between maintaining liquidity and making strategic investments. Compared to the industry, FedEx stands out with lower debt to assets and debt to equity ratios. These lower leverage ratios suggest that FedEx takes a more conservative approach to debt than its industry peers, which minimizes financial risk. This conservative strategy helps position FedEx as a financially stable company with strong long-term growth potential, which is very appealing to investors looking for a low-risk investment. From an investor's perspective, FedEx's capital structure is likely viewed positively. Their lower leverage ratios and stable debt levels suggest a financially stable company with a conservative approach to risk, as mentioned beforehand. One possible concern could be the limited use of short-term debt, which might reduce operational flexibility, but the focus on long-term debt for strategic growth is generally seen as positive. Overall, FedEx's conservative capital structure and effective debt management are likely to be seen as positive by potential investors. The company's focus on long-term debt to support growth and its lower reliance on short-term debt provides confidence in its long-term stability. Investors who prioritize financial stability and low risk would likely find FedEx to be an attractive opportunity, as mentioned in the previous slide. To summarize that first part, FedEx maintains a strong conservative capital structure with lower leverage ratios compared to its industry peers. Their focus on the long-term debt supports their strategic growth while keeping financial risk low. For investors, this balance between stability and growth makes for a promising investment opportunity. In 2023, FedEx issued a €600 million sustainability bond. This was part of its larger goal to achieve carbon-neutral operations by 2040. The capital raised is being used to fund environmentally friendly projects such as reducing carbon emissions and improving energy efficiency across its operations. The key characteristics of the FedEx 2023 bond include its denomination in euros, with a total of €600 million raised. This is an 8-year sustainability bond, making it unique as the first of its kind issued by a North American transportation company. The bond takes advantage of favorable market conditions, providing FedEx with a long-term funding for its sustainability initiatives. The bond was initially rated A by credit rating agencies, reflecting FedEx's strong financial position and manageable debt levels. As of now, the bond maintains its A rating as FedEx has continued to demonstrate solid financial management. This stability is due to consistent revenue growth and the strategic reduction of near-term debt obligations. At present, the exact bid and ask prices for FedEx's 2023 bonds are unknown. Of course, it's always important to remember that these prices fluctuate based on market conditions, investor demand, and company's credit rating. Unfortunately, I was unable to find the bid price and ask price in that bond issuance, as well as all of the PDFs and different things that they put out for people to read. So unfortunately, I was not able to locate that. From an investor's perspective, the stable A bond rating and the sustainability focus make this bond an attractive long-term investment. Its alignment with environmental goals may appeal to socially responsible investors. Additionally, the strong financial performance and low risk associated with FedEx bonds offer a reliable return for those seeking a secure investment in the current market. For my design statement, this activity was completed using a combination of resources. These resources included information from financial websites, FedEx's official site, as well as the previous presentation created regarding key ratios that I submitted 2 weeks ago. Here are the references used throughout this presentation.